Hey, good morning once again, options traders. Well, all of the new traders they seem to be so focused on theta and so worried about their option decaying over time that they start turning to strategies that probably don't really fit with their outlooks. And that's why a lot of times people turn to diagonal spreads and vertical spreads, and not that there's anything wrong with those strategies, but there is something wrong if they don't fit your outlook. So as a way to kind of ease the concern about theta, let's change the question. What's it worth to cancel your call option? Let's say that the stock has moved against you and you say, you know what, I want out of the option. I don't want to have to buy that stock. What would that be worth to you? Well, this goes back to a point that I've made several times in past videos, that calls are puts and puts are calls. They are really two different ways of looking at the same problem. And most people understand that puts offer protection. They usually make the analogy that a put is like an insurance policy against your shares of stock. But it's actually both. Calls and puts offer protection. Now again, we usually find it fairly easy to see where the put options protection is coming in, but the call options insurance value isn't so easy to see. So for instance, let's say that we have a $100 call. And what if the stock is 90 at expiration? Well, if that were true, the $100 put would be worth 10 bucks. That's because you'd have the right to sell the stock for 100. It's currently trading at 90. That put would be trading for $10. Well, now think about this. If you had the $100 call, and let's say it was instead a futures contract, where you have to take delivery unless you cancel the contract or do an offsetting position, what would this be worth to you? Well, it's now -10. You've got to buy stock for 100 that's currently trading at 90. What would it be worth to cancel that contract? Well, it would be exactly 10 bucks. This is exactly the amount you'd pay to cancel the contract. So if we look at our bell curve, remember that the center of the curve is where the current stock price is. And let's say that it's currently at 100 and we've got the 100 strike. With the stock down here at 90, then that call would be worth 10 bucks to cancel that contract. We could also say that's the value of the put. But the call is insuring us, in this example, against all stock price drops below 90, this red area. So the question is, how likely is it for the stock to hit this red area? Well, that's where the pricing model comes in, and whatever this probability is, and technically we'd have to look at the weighted average of all of these potential prices that we could have, we can figure out what we should pay for the insurance policy. But let's go look at a simpler way to understand option pricing. Remember that a call option can be thought of as the intrinsic value, if there is any. So that means the intrinsic value could also be 0. There's a cost of carry. In today's world, not much of one. But if you have any interest rates at all, and or expensive stocks, long times till expiration, then yes, the cost of carry component can get quite big. But then finally, there's an insurance component to a call option. This is the part that people fail to see. So let's say that the stock is currently trading for 100. Interest rates are 5%. I'm going to give a volatility, let's say at 30%, and we're going to look at a 60-day $95 call. And if we throw that into a pricing model, it says that it's worth $8.15. But remember that this $8.15 is made up of these three components. So let's go through them. How much intrinsic value is there? Well, if the stock is 100 and we've got the 95 call, there is $5 of intrinsic value. So we know that the call option has to trade for at least $5. There's what's called an arbitrage opportunity if it were trading for something less than 5. So we know it's got to trade for at least 5. All right, what about the second piece here, the cost of carry? Well, the cost of carry in this example is the 5% interest rate times the time, 60 days out of 360, or about 16% of a year. So that comes up to be 0.008. And that just means we're going to multiply this amount times the amount that we are effectively borrowing. So this number, this 0.008, means that we're going to multiply that by the strike. Because remember, that's the part that you are mathematically borrowing. You have stock that might be trading for 100 right now, but if you choose to exercise your call, you're not going to pay 100, you're going to pay 95, and you're going to pay that in 60 days. So that's why we have to multiply this interest by the strike price. So we're going to take the 95 strike times this 0.008, it gives us 76 cents. So now we know that the call must trade for at least $5.76. But we know it's trading for $8.15. We've accounted for $5 of intrinsic value, 76 cents for the cost of carry, but there's also this insurance value that is coming from the put. So if we know these two pieces of the puzzle, $5.76 worth, what's the value of the put? Well, it's just $8.15 minus $5.76. The put should be worth $2.39. So that's what we are paying up for this insurance policy. It's giving us the right to walk away. And that is critically important when you are doing and setting up your option strategies. So let's go have a look at a pricing model. There it is. There's our 100 stock, 95 strike, 60 days to expiration, 30% volatility, and 5% interest rates. There's the $8.15 call price that we saw, and about $2.37 for the put. Now, the reason we came up a couple of cents higher, most likely, is that this model is probably using 365 days in a year, whereas we used 360. But regardless, you can see that we are coming up very close to the amount that we are paying for the insurance value for this call. That is giving us the right to walk away. So again, even though you see the $8.15 call, $2.37 worth of that is absolutely coming from the insurance value. So the reason that this is important is that you have to be careful about closing call options just because of theta. So remember that if this is today, you've got some kind of an outlook, whether it's an upcoming earnings play, just a swing trade over a certain period of time, you just like the company, you think it's going to do well over the next 6 months, whatever your outlook is, you have to have some type of a reason for getting into it. And you've got some type of an expiration date in mind that your idea here is going to come true. Now, the insurance value that you're paying for applies to this entire range. So think about it. If this is your outlook, represented here by the width from today to expiration, and we think that something is going to happen in this time frame, why should we close it and shut down our option, let's say at the halfway point, just because of theta? That's saying that we now think that this event is going to happen in the first half, or that we think it's far more likely to occur in the first half. Well, that's not what we said when we put the position on. What makes us think that it's more likely to occur in the first quarter, or the second quarter, or maybe the third quarter, or the fourth? If that's not part of your plan, you have to really question if it makes sense to close your call early just because of theta. Theta is a direct result of the insurance value of that call over time. So again, that's not saying that it's bad to worry about theta or to try to offset it, but you need to do it for the right reasons. Otherwise, you're going to find that you could be right with your outlook and still lose with your strategies. And so for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.